And quite a day to have you here. You know, about a week and a half ago, you said that if conditions were pretty much the same as they were then, you would be on board. You would probably be supporting a 75 basis point rate hike. Now what we saw in the inflation report, even higher than expected, few signs that inflation is easing up. Would you be on board potentially with a 100 basis point hike at the July meeting?
Well, Kathleen, we don't have to make that decision today, and there's more data coming out that I'm going to be very attuned to. We have retail sales coming out on Friday, and we have a very important University of Michigan report. And of course, that's important because it has the inflation expectations measure, a consumer measure in there. So, you know, we have data coming out. What I take from the report, and it was uniformly bad, there was no good news in that report at all, was that inflation remains at an unacceptably high level. We at the Fed have to be very deliberate and intentional about continuing on this path of raising our interest rate until we get and see convincing evidence that inflation is turned the corner, is on a downward path, and is sustainably on a downward path, and that we just have more work to do. So, you know, we'll make that decision about, you know, what the right number is in terms of the rate increases, but we're going to have to continue on this path because we haven't seen monthly numbers coming down. As you pointed out at the top of the hour, you know, even the monthly numbers are moving in the wrong direction. So we just have to be very intentional here. The Beige Book came out today as well, and as you saw in that report, and that's a nice report because it really shows you across the country our business contacts and consumer contacts. There's concern about recessionary risk going up, but the main point in that report that I took was there is continuing to be price pressures, no alleviation there, and that some of the moderation in demand is really being driven by the fact that consumers have to pull back some of their discretionary spending because the prices of food and energy and other essentials are so high.
So let me ask you this. Is 100 basis points, if we had asked you about 100 basis points a couple of weeks ago, 2 or 3 months ago, I don't even think we'd have thought to ask you. But is that something, though, you could see being discussed? Would you discuss it? Is it something, given what we see in inflation now, that is, quote unquote, on the table, that maybe has to be under consideration because the Fed has to figure out just how aggressive you have to be?
Well, we're going to have the meeting and we're going to talk about what the appropriate path of policy is. And again, you know, we don't have to make a decision today. We're going to take into account all the data. But, you know, we're having this conversation. The markets are having a conversation and putting their money where their mouth is in terms of where market expectations are. So we're going to be talking about the appropriate path of policy. And I have not seen any convincing evidence that inflation has turned the corner, right? We haven't seen anything that in that new CPI report that suggests inflation is turning down. Now, we do know that energy prices, right, have fallen compared to the prior month. So there's some expectation that the next report on inflation, we might see that part going down. But on the other hand, we have shelter prices going up. So again, you know, I think it's much more. The focus, I think, is on the fact that we're going to have to keep moving interest rates up, being very deliberate and intentional about it.
Right.
You know, if you know, we're moving toward a 2.5%, what the long run neutral rate is. My own belief is that we're going to need to go beyond that and well beyond that because, right, inflation and inflation expectations are higher than 2% now. So we're going to have to keep moving. And the pace at which we do that at and, you know, what any particular meeting is really going to be driven by, are we seeing demand get into better balance with constrained supply, which remains constrained, in order to see that inflation get on a sustainable downward trajectory. So, and we have not seen that.
So given what you've seen, given today's report, or will you consider, are you in a position to, again, you've got a couple weeks, 2.5 weeks basically, or so to figure it out, but 75 basis points, for example, is that something that you are leaning more now to saying, yes, that's something I may be supporting at the July meeting?
Well, certainly the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction. There are very, very early signs in some of the reports of an easing of demand. But again, not enough that you actually saw price pressures being alleviated. We have our board of directors meeting tomorrow. You know, I'm particularly interested in what they're seeing in the economy. We have those data reports I mentioned. They're going to be significant. But right now, job one for us is to get inflation under control. And I say that knowing that the risk of recession have gone up. But that's, you know, part of what we're trying to do is normalize or moderate demand, because if we don't do this, right, we're going to have many more problems in the economy going forward. So we've got to do what we can do on the demand side, and that's where our tools work to get that demand moderation. So, you know, some people are, if you read the reports, you know, we're looking for some moderation in demand. The economy is still strong on the demand side. There is preparation and concerns about recession. But if you look at, you know, some of the data, right, firms in our district are telling us they're still, you know, they may be moderating some of their plans because they think demand will slow. But other firms are saying we're holding back because our demand is still staying up. So again, right, the focus has got to be on the inflation part of the mandate.
Loretta, does the Fed have enough time to telegraph a 75 basis point hike or even more until the next decision, given that last time when you guys really hiked more, there was a lot of questions about the credibility of the Fed, and does that even matter at this point?
Well, I think our credibility is that we showed at the last meeting that we are responding to not one data report, and I know that was kind of the reports. I was like, wow, that one report made them move. It was, again, looking at the plethora of data, all the data that come in the intermeeting period, and in recognizing that, you know, in this environment, given what the data is pointing to, we needed to be more aggressive. And I think that enhances our credibility, doesn't detract from our credibility. But I take your point in that we don't want to do things that are not, you know, communicative. We want to make sure that we're communicating as clear as we can how we're judging policy and what our rationale for moving policy rates up. So I was fully on board with 75 at the last meeting because the data moved in a direction that suggested we've got to go faster and we got to move, you know, to what would even be a long run neutral Fed funds rate. And in this environment, that's not neutral because inflation is so high.
Yeah.
Could a full percentage point move be more about signaling as opposed to even just transmission? Are you worried that there's now pretty meaningful entrenchment of the inflation psyche when it comes to the consumer?
Yeah, not yet, but I do think we have to be very attuned to that. So, for example, so far, if you look at longer term inflation expectations, they've moved up, but they're still at the upper range that we've seen, you know, since the mid 2000s. So in that sense, we haven't seen that entrenchment yet. But the longer inflation remains at these very high levels, the more risk there is that could happen, and that means that getting inflation down will be that much more costly. That's why it's very incumbent upon us to really stay the course here, continue moving in this direction, and really be very looking for compelling evidence. It can't be like one inflation reading moving down and then we declare victory. We've got to really stay the course here. And that's what's it's gonna take, because that will alleviate pressures as demand moderates, getting more in balance with supply.
Can I ask a quick follow on that to be very specific? Is there like, you have to see the headline inflation year over year stabilizing? Does it have to go down for 3 months? Does it have to go down to 4 months? Is there a level it has to hit for you to say, in a certain period of time, to say, okay, we can pause, we can slow down the rate hikes? Give us just some more specific idea of how you're looking at this.
Personally, what I want to see is a series of monthly increases in core and in headline where it's moving down. That's what I want to see. I mean, the reason the headline is so important is that that's what
Okay.
people actually pay, and that has a bigger impact on inflation expectations because that's what people see. And so
Okay.
again, we need to see inflation, and I also want to see, evidence that inflation expectations have stabilized. Because
Okay.
if you think of a risk management way of viewing policy, right, we have to be really pretty much not allowing inflation expectations to move up. And so you're better off from a risk management perspective is if you think they're moving up, treat them as if they're moving up in your policy decisions.
Well, and thank you for clarifying the monthly changes, because I think a lot of people, the Fed is looking at the year over year. That's very important. One more thing, shelter costs. They were up on the monthly rent payments. They were up on owner's equivalent rent by very big amounts, highest in, 20 or 30 years for each of those. How concerned are you about that? And the upward pressure that it's going to continue to put on inflation, even as some of their costs are coming down. Could that extend the period of aggressive rate hikes?
Well, I think the shelter cost thing is definitely something to be concerned about because typically those, as you said, right, that's a more persistent part of the inflation, right? So we see that coming. And what's interesting about this environment is we have seen housing activity moderate in response to the Fed moving interest rates up, as you'd expect. But because housing inventory is so low, right, you haven't really seen that much happening in terms of demand for housing. So demand's coming down because of the mortgage, but the actual sales data haven't really moderated, at least in our district, from our contacts are telling us. So again, this is a very challenging environment for a number of reasons, and the reads from the economy are, there's some conflict, right? We see slowing activity, like in the GDP report, negative, and some slowing in retail sales. But on the other hand, we see very strong labor markets and continuing strong growth in employment. So again, I think there's a lot of uncertainty over the outlook. I think what's not uncertain at all is that inflation is way too high, and we need to use our tools at the Fed to do our work to get inflation under control and moving down over time to 2%. I think you're exactly right, Kathleen, that it's going to take time for inflation to come down. My forecast does not have inflation coming back to 2% until late, right, 2024 and a little bit beyond that. So again, can we tolerate that? Yes, as long as we know it's sustainably on that downward path back to 2%, and we know that inflation expectations are anchored at 2%. This is the key thing for me.
So it may not be a straight trajectory, because when we spoke, I think just a month ago, you were saying you were at that point not predicting a recession. Have those recession risks risen for you now? Has that view changed? And the nimbleness of how the Fed responds, what does that look like if there is a recession?
Yeah. So for sure, inflation risks have risen. I mean, I think we've seen that we've had to go more aggressively, for example, in July. Right, and we've seen that inflation has been stubborn. Right, we know that it's stubborn and it's going to take time. So the recession risks have risen. That said, right, there are a number of things that are still strong in the economy. Right, demand has moderated a bit, but we still have strong demand in travel for sure, in certain service sectors. Right, we certainly have a strong labor market. So again, I think the path towards price stability is going to entail some pain, but less pain if we do it than if we don't do it. So again, we're going to have to make some trade-offs later on. And, as you looked at the SEP, the forecast from the Fed the last time, right, you see that we do have the trajectory of unemployment moving up, but still a strong labor market, and we do have growth going down. And the recent forecast suggests that growth in the second quarter, is flattish, maybe negative again.
So is the labor market the indicator for you about recession fears when you start worrying about that?
Well, I think that a strong labor market and a healthy labor market certainly mitigates some of the pain that a reduction in output would have. So again, to the extent that we can keep people employed, if the unemployment rate goes up a bit, and that's the price we have to pay for getting this inflation down from unacceptably high levels, I think that's how I'm viewing it. I mean, because it's really important to do this because I don't really even see this as a trade-off at this point, right? If we don't do what we need to do to get inflation under control, we are not going to have healthy labor markets over the medium to longer run. The only way to have a strong economy and healthy labor markets is to make sure we are on a path back to price stability. So I'm not even thinking that, wow, we're facing this trade-off, we have to make a choice. We don't have a choice. We have to do it.
Right. Okay. And Loretta, you're part of the global central bank, brotherhood, sisterhood. Lot of rate hikes. We had the Bank of Korea and the Reserve Bank of New Zealand doing 50 basis point rate hikes. New Zealand saying they're going to do more. Are you concerned with so many central banks around the world, not just hiking rates at the same time, but boosting the size of their rate hikes? Bank of Canada did the 100 basis point rate hike today, that this is going to take a toll on the global economy, that it could lead to more of a global slowdown, which will surely affect the U.S. As much as it affects other countries in the world.
Right. But yes, you're right. We've seen this high inflation being a problem globally, and we have seen monetary policymakers take actions globally to get demand into better balance with supply. And so as we're going through the rest of the year and into next year, one of the things we're going to be gauging is, well, how much is demand slowing in the U.S., and is it getting into better balance with supply? And some of the conditions globally will affect the U.S. economy, as they always do. So that's part of the assessment, right? As we go forward, that is important that we do so that we then can calibrate our policy appropriately to what's happening in the U.S. economy. So you're exactly right. That's one of the factors, right, that's going to affect the U.S. economy going forward. And that's one of the things we're going to have to keep, when we look at, well, what are we projecting for the economy? That's going to be one of the factors that we're looking at. If we see this tightening in financial conditions globally, that affects the U.S. economy.